Hello everyone and welcome to This Week in the Markets. In today's video, we will go through the news from last week, in particular the easing of the monetary policies from Global Central Bank, the non-farm payroll report, and also its potential effect on Fed monetary policies. But before we continue, let's first go through the disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So last Thursday, the Bank of England, the Bank of China, and the European Central Bank all announced easing measures just minutes apart from each other. The Bank of England expanded its asset purchase program by another $50 billion to a net $275 billion as it stands. The Bank of China lowered its interest rate by another 25 basis points after the previous cut in June, and the European Central Bank also reduced its benchmark rate by 25 basis points. All in all, the seemingly coordinated effort should provide good support for the markets, but instead, markets ended lower that day. Part of the reason why the markets did not respond positively was because of the comments from the president of the European Central Bank, who said that the economic growth in the euro area continues to remain weak with heightened uncertainty. There were also hopes that the European Central Bank would take on some form of quantitative easing program, but that did not eventuate. Nonetheless, in a later meeting, Mario Draghi, the president of the European Central Bank, did signal that the bank is open to another interest rate cut if it is required. The Bureau of Labor Statistics in US reported its much-watched non-farm payroll report on Friday, and for the third consecutive month, this number fell short of investors' expectations. This report suggests that the US added around 80,000 new jobs in June, but analysts were actually expecting more jobs at 100,000 jobs. This adds to the concern that the recovery in the US is slowing due to the contagion effect from Europe. Nonetheless, there is a silver lining to a weak jobs report, and it is that it encourages the Fed to take on more aggressive actions, and perhaps even engage in another round of quantitative easing. Now, a little bit of background on quantitative easing. It is basically a monetary policy where the central bank buys financial assets. This is usually government bonds from the market. On one hand, this helps to keep the asset price high, while at the same time it floods the banks with excess reserve, which hopefully will translate into increased lendings and liquidity, which in turn will help to boost the economy. According to the minutes from the last Fed meeting, most policy makers were not ready to engage in another quantitative easing program. However, the last meeting was held before the disappointing non-farm payroll report, and several officials did say that they are willing to take new measures if the employment continues to sag. So the weak non-farm payroll may actually encourage the Fed to take on bolder actions in the next Fed meeting, which is scheduled at the end of the month. On Monday, finance ministers in the euro area met to discuss Spain's bailout. Outcomes from this meeting include extending the deadline until 2014 for Spain to meet its deficit reduction target, and also agreeing to offer Spain 30 billion euros by the end of the month to help its troubled banks. Nonetheless, this is conditioned on the officials first obtaining approval from the governments and then finalizing the agreement on the 20th of July, where they will meet again. The earnings season in US began on Monday with the release of Alcoa's second quarter report. Its earnings per share and revenue both came in above expectations, and the CEO also forecast a stronger demand for aluminium this year, citing strong demand from the transport and aerospace industry. This is a positive sign for the market as aluminium is one of the world's most widely used metals, and it also has lots of economic implications. On the other hand, however, Cummins, the truck engine maker, is less optimistic about the market, and it cut its outlook on its revenue on Tuesday, citing a slowdown in global demand because of the Eurozone crisis. So far, in the US, only around 26 companies from the S&P 500 have reported their earnings, and although there is a net 2.3% upside in earnings surprise, it is a bit too early to judge at this stage. We'll continue to track the company earnings in the following weeks and to see how the US companies fared in the second quarter. Today, the Bank of Korea became the fourth central bank to ease monetary policies in the last week. It cut its borrowing cost by 25 basis points to 3%. Japan also quickly followed to become the fifth as it expanded its asset purchase program by 5 trillion yen. Both actions were unexpected and demonstrate how nervous central banks have become. As we said in the last week, all these central banks' intervention could eventually lead to a surge in precious metal price as paper currencies become diluted. Currently, gold and silver prices are still very low because the market is focused on Europe and the deflation fear over there. But if central banks continue to debase their currencies, we could have a situation like 2009-2010, where investors surge into commodities for inflation hedges. The straw that breaks the camel's back might just be another quantitative easing program from the Fed. So we'll be keeping a close eye on the Fed meetings and also the market expectations of another quantitative easing program. Now that is all from us this week. For the coming trading week, keep an eye on Chinese GDP data, which will be out later today. China has become one of the world's largest consumer, so the strength of its domestic market also has a strong impact on the global economy and the stock market in return. Also keep an eye out for the Consumer Price Index in the US, which will be released next Wednesday. The Fed has a dual mandate for keeping inflation and jobs in the US at a target level. So we already have jobs report last week that fell short of target, and if inflation also follows to be below the target level, it might put more urgency on the Fed members to engage in more stimulus. We'll go through this data again next week. Until then, on behalf of the Trading Pursuits team, we wish you a profitable trading.